Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way. So I want you to imagine a single stretch of water, barely 21 miles wide, basically holding the entire global economy hostage.
Which is a terrifying thought, honestly.
Right. But that is exactly where we find ourselves today. According to the recent data, the conflict involving Iran is it's officially entering its second week now, and the tension is just palpable.
Yeah, everyone is on edge.
Exactly. All the parties, so Iran, Israel, and the U.S. are holding these deeply entrenched hardline stances. But the detail that's sending absolute shockwaves through the financial world is Iran's new supreme leader, Mojtaba Khamenei, repeatedly threatening to close the Strait of Hormuz.
Which, I mean, without exaggeration, that is the single most critical geopolitical choke point on the planet for energy. When you choke off that specific waterway, you aren't just creating some regional political crisis. You are fundamentally altering the mathematics of global trade. We're witnessing a massive psychological shift in the markets right now.
And the optimism is just completely gone. Wall Street has entirely stopped hoping for a short-term, diplomatic end to this war. We're looking at a market that is now pricing in a prolonged, grinding energy shock.
It's a total reset of expectations.
It is. And the mission of our deep dive today is to help you figure out exactly how this global shockwave is going to affect your wallet, your savings, and your retirement accounts. We want to translate these massive, sweeping global events into actionable realities for your 401k, completely jargon-free.
Because, to protect your wealth in an environment like this, we really have to look past the flashy, anxiety-inducing news headlines. Headlines are designed to hijack your amygdala and keep you scrolling. They don't...
Right, they just want your clicks.
Exactly. They don't actually tell you how to defend your money. To do that, we have to follow the actual flow of capital. We need to watch where the money is moving under the surface because capital flow is the only truth teller in a geopolitical crisis.
Okay, let's unpack this. Let's move from the terrifying headlines of the conflict to the immediate financial chain reaction. Because the very first things to react to this war weren't the stock markets.
Yeah, not at all.
It wasn't the New York Stock Exchange or the tech sector that moved first. It was the raw materials that physically power human civilization and the currency we use to purchase them.
The literal foundation of the modern world, crude oil and the U.S. dollar. I mean, basically everything else is downstream of those two assets.
So let's tackle the oil shock first, because the scale of this move is staggering. Since this conflict really kicked off on February 28th, Brent crude and WTI crude, which are the two main benchmarks that dictate global oil prices, they surged by roughly 36% and 39% respectively.
Huge jumps, just massive.
Yeah, they briefly shot past $119 a barrel. Now, based on the latest analysis, they've settled just a bit. We are currently sitting at $99.85 for Brent and $95.05 for WTI.
Yeah.
But hovering right around that $100 mark, I mean, that's a massive psychological and economic threshold.
Right. And naturally, when prices gap up that violently, global organizations just scramble to extinguish the fire. The International Energy Agency, the IEA, responded by agreeing to release a record 400 million barrels of reserve oil into the market. It's really a historic intervention.
Now, wait a minute. I have to push back on that sounding like a massive victory.
Oh.
Yeah, because when I hear 400 million barrels of oil, that sounds like an absolute ocean of supply being dumped onto the market. Logically, shouldn't that just crush the price back down to normal? Why are we still hovering near $100 a barrel if we just unleashed an ocean of oil?
Well, think of it like trying to put out a roaring 5-alarm house fire with a standard garden hose.
A garden hose? Come on, it's 400 million barrels.
I know it sounds like a lot. Yes, water is coming out. Yes, it is helping. But the volume of the fire is simply outpacing the volume of the water. We have to look at the mechanics of the Strait of Hormuz. If that strait is closed or even just severely restricted by military presence and, exorbitant insurance premiums, it traps roughly 20 million barrels of oil every single day.
Wow. 20 million barrels daily. So
Yeah.
if you take that massive 400 million barrel release from the IEA, you divide it by the 20 million barrels we are losing daily?
Exactly.
Do the math.
A historic, record-breaking intervention only covers about 20 days of lost supply.
Right. It is a buffer. It's not a cure. And there's a physical reality to the oil market that people often forget. Oil doesn't just teleport from a strategic reserve into the gas tank of your car.
Yeah, I wish it did right now. Right. But these reserves are often stored in massive underground salt caverns or remote facilities. Releasing them means physically pumping that oil out, loading it onto specialized shipping vessels, transporting it across the ocean, getting it into a refinery, processing it into usable fuel, and then trucking it to distribution centers.
That sounds like a logistical nightmare.
It is. It takes weeks, sometimes months, for that released oil to fully reach the physical market. So the supply shock we're facing is immediate, but the relief is incredibly slow.
Which brings us to the second massive domino to fall, the double threat of the U.S. dollar.
Yes.
The dollar is seeing its second consecutive week of aggressive gains, nearing its highest level since last November. Now, traditionally, when a major war breaks out, global capital flees to the dollar because it's the ultimate safe haven, right? It's the mattress the entire world stuffs their savings into when they get scared.
Yeah, that risk-off dynamic is definitely in play. But there is a second, far more powerful engine driving the dollar higher right now. And it is a really fascinating macroeconomic shift. It comes down to the fact that the United States is now a net energy exporter.
Meaning the U.S. physically produces and exports more energy than it imports from the rest of the world.
Precisely. The shale revolution over the last decade completely rewired the American economy. We aren't living in the 1970s oil crisis anymore.
Right.
When you have a global shock where energy prices skyrocket, countries that import all their energy, so think of major manufacturing hubs in Europe or Asia, they're suddenly hemorrhaging massive amounts of capital just to keep their factories running and their power grids online.
Oh,
But the United States has a profound structural advantage. Yes, the American consumer feels the pain at the gas pump. It hurts domestic wallets. But on a macroeconomic national level, the country has a relative upper hand because the U.S. is selling that incredibly expensive energy to the rest of the world.
okay, so just to translate this for the beginner investor listening,
Yeah.
that is a crucial distinction. When energy prices go to the moon, the U.S. economy takes a hit, sure, but it takes a significantly smaller hit compared to nations that rely entirely on foreign oil.
Exactly.
That structural advantage makes the U.S. economy look incredibly resilient by comparison. So global investors see that resilience, and they pour even more money into the U.S. dollar. It's a double whammy. You get the traditional safety of the dollar, plus the structural dominance of an energy exporter.
Which creates a vicious cycle for everyone else. Because oil is priced in U.S. dollars globally. If you're a country in Europe, not only is the barrel of oil more expensive, but the dollar you have to buy it with is also more expensive.
That's brutal.
It acts as an economic wrecking ball for energy-dependent nations. Understanding this dynamic is really the key to surviving the current market.
Well, if the U.S. and Europe are bleeding cash to buy oil at $100 the barrel, that money is going into someone else's pocket. Who is actually cashing those checks? Let's look at the surprising geopolitical winners in this scenario. And I have to admit, the data regarding Russia completely blew my mind.
It is one of the most remarkable pivots in recent market history.
Seriously. From a strictly financial standpoint, Russia is actually emerging as the most direct beneficiary of this entire crisis. Before this war began, Russian Urals crude, specifically the oil they export to India, was heavily penalized. They had to mark it down by a massive $10 to $13 a barrel compared to the Brent benchmark.
Just to convince buyers to take on the political and logistical risks of international sanctions.
Right, but today, because the global market is so starved for energy, that massive discount is completely vanished. They're now selling that exact same oil at a $4 to $5 premium. I mean, they're making significantly more money on their oil right now than the global average. How did that even happen?
Well, the mechanism behind this shift involves some very pragmatic policy decisions. Because of the sheer panic over the potential closure of the Strait of Hormuz, the U.S. Treasury, under the current Trump administration, stepped in to ease the pressure valve.
Okay.
They granted a specific 30-day license, which expires on April 11, allowing the maritime trading of Russian oil and petroleum products that were previously restricted.
Wow. It just perfectly illustrates how unsentimental and, pragmatic the financial markets are. It's like a banned casino player who was kicked out by management and told to never return.
That's a great way to put it.
Yeah. But then, on the busiest Saturday night of the year, the casino completely runs out of chips. Suddenly, the management looks outside, sees that banned player standing there with a trunk full of chips, and immediately rolls out the red carpet. They give him the VIP suite and a free buffet just to get those chips back onto the tables.
The global economy simply ran out of chips. In a matter of days, Russian barrels transformed from sanctioned toxic assets that nobody wanted to touch into essential market stabilization tools. Russia is experiencing a massive direct surge in short-term cash flow simply because they hold the exact asset the world is desperate for.
So we always hear Russia and China mentioned in the same breath during these geopolitical conversations. Is China making the same kind of windfall profit off this energy shock?
Not at all. They're playing an entirely different game.
Oh, really?
Yeah. While Russia is capturing direct, immediate cash flow by selling expensive crude oil, the data shows China is playing purely defensive. In March, China virtually halted all of its exports of gasoline, diesel, and aviation fuel.
That's fascinating. So instead of refining crude oil and selling the expensive finished products abroad to cash in, they are hoarding it. Why would they do that?
Because China is the factory floor of the world. They
Yeah.
have over 1 billion people and a massive industrial base that requires a continuous, uninterrupted flow of diesel and electricity just to maintain social and economic stability.
All right, they can't afford the lights to go out.
Exactly. They aren't trying to make a quick profit on the global market. They are terrified of internal domestic shortages. If their factories stop running because there's no diesel for the trucks or the generators, the economic fallout would be catastrophic for them. So they lock the doors and keep all the fuel for their own domestic market. It's a strategy of containment.
And it's important to view this impartially, outside of the typical political narratives we see on TV. We know that on March 12th, at the UN Security Council, Russia and China clashed with the U.S. regarding the justification for the conflict. But a Reuters analysis from March 5th highlighted a very crucial detail. Neither Russia nor China are militarily betting on Iran. They are not stepping into the ring to fight. They are simply acting to maximize their own strategic and economic interests in a highly volatile environment.
That is a critical nuance. When analysts say China is benefiting from this crisis, it is a purely relative benefit. They aren't making a windfall profit. They are simply hurting a little bit less than other major oil-importing nations because they are aggressively hoarding their domestic resources to keep their own engine running.
Here's where it gets really interesting. Let's bring this massive geopolitical chess game back home to Main Street. How does a global energy crisis physically alter the American financial landscape, and specifically the investments of the person listening right now? It all comes down to the death of the rate cut dream.
This is the macroeconomic shockwave that will dictate the value of every single asset in your portfolio.
Because just a month ago, the market was incredibly optimistic. Wall Street was thoroughly convinced the Federal Reserve was going to cut interest rates by 50 basis points, like 0.5%.
Right.
That expectation of cheaper borrowing costs was acting like a massive shot of adrenaline for the stock market.
Right.
But today, based on the numbers, that expectation has collapsed to just a 20 basis point cut. The dream of easy, cheap money is just evaporating.
And the timeline is shifting just as violently. Goldman Sachs has officially pushed their prediction for the very first Fed rate cut from June all the way back to September.
Wow, September.
Yeah. And the European Central Bank, the ECB, they're scrambling to reevaluate their entire monetary strategy. We see this fear reflected instantly in the bond market. The 2-year U.S. Treasury yield shot up by 35 basis points to around 3.73%, and the 10-year yield went up 20 basis points to about 4.16%.
And for anyone who doesn't watch bond yields every day, yields act like financial gravity. When yields go up, the present value of future corporate earnings goes down. It pulls the valuation of the entire stock market closer to earth.
Exactly.
And this is all happening because inflation is back on the menu, driven entirely by these soaring oil prices.
Yeah.
Which brings us to the most terrifying word in economics, stagflation.
Stagflation is the absolute nightmare scenario for any central bank. It is the dangerous, toxic combination of higher inflation driven by these rising energy costs paired with lower economic growth, because expensive energy acts as a tax on every single business and consumer.
Yeah, stagflation essentially forces the economy to drive on the highway with the parking brake stuck.
I love that analogy.
Right, because growth is grinding to a halt because businesses can't afford to expand. But the fuel you're burning just to fight that friction, the inflation is doubling in price. It's
Yeah.
the worst of both worlds. Your engine is working twice as hard to go half as fast, and it's burning a hole in your wallet.
And we are already seeing the economic engine sputtering. Over a 3-day period ending March 12, the S&P 500 suffered its biggest drop in a month.
Ouch.
And it was a broad systemic drop. Almost every single sector of the economy, except for energy, took a significant hit. Industrial sectors suffered immensely because they rely heavily on cheap energy to manufacture physical goods. Financial sectors took a beating because they are highly sensitive to the chaos surrounding interest rates.
What's truly concerning to me is that the traditional hiding spots are failing. Usually when the stock market gets scary, Investors run to long-term bonds or gold or large reliable growth stocks. But right now, all of those assets are shaking. The old rules for defending your capital are breaking down in real time.
Because the nature of the threat is different. We aren't just facing a normal recession, we are facing an inflationary shock.
Which leaves us with the ultimate question. If the traditional safe havens are compromised, where do we actually park our capital? So what does this all mean for the listener right now? Let's build out a timeline, starting with the immediate fallout. What is the short-term playbook for the next 1 to 3 months?
Well, the short-term strategy right now must be entirely focused on defense. Since we know energy prices are elevated and interest rates are staying higher for longer, you want to look for low volatility assets. You want investments that generate strong, reliable cash flow today, regardless of what the broader market is doing.
So things like high-quality dividend-paying stocks.
Exactly. Think dividends. Furthermore, you want to be positioned in U.S. dollar-backed assets because the dollar is currently flexing that immense structural advantage we discussed earlier.
On the flip side, what specific areas of the market are the most dangerous right now? What should we avoid?
You want to severely limit your exposure to Asian markets. Countries like South Korea, Japan, Taiwan, and India are incredibly vulnerable right now.
Because they're the ones importing all that expensive oil.
Right. They are caught in a devastating macroeconomic trap. They rely heavily on oil imported from the Gulf region. First, they have to pay astronomically high base prices for the physical crude.
Right.
Second, because global oil is traded in U.S. dollars and their local currencies are weakening against the surging dollar, the true cost of that oil is compounding. It absolutely crushes their corporate profit margins and drains their national reserves.
So for the next 1 to 3 months, we play defense. We prioritize cash flow, we lean into U.S. dollar strength, and we avoid heavy oil importing regions in Asia. But what are the specific tripwires we need to watch to know if the situation is changing?
There are three critical indicators. First, watch the actual price of crude oil. Does it stay stubbornly pinned near $100 or does it start to drift downward?
Okay.
Second, monitor the news specifically for the speed at which the Strait of Hormuz might reopen or normalize. The physical flow of oil dictates everything else. And third, pay extremely close attention to the Federal Reserve meeting on March 17th and 18th. The exact words the Fed uses to describe their view on inflation and growth will dictate the stock market's next major directional move.
Okay, so that is the bunker strategy for surviving the immediate storm. But markets are cyclical. Nothing lasts forever. Energy and the dollar are winning now. But let's zoom out and look at the medium-term playbook, looking 6 to 18 months down the road. What happens when the dust eventually settles?
This is where the massive opportunity lies for the patient investor. If you can survive the short-term volatility without panic selling at the bottom, the medium term gets very exciting. Eventually, supply chains will normalize, the geopolitical crisis will de-escalate.
Hopefully sooner rather than later.
Right. And when that happens, the specific investments that are getting absolute crushed right now, like rate-sensitive growth stocks and long-term bonds, are primed for a massive recovery.
It's like a heavy rubber band being pulled back as far as it can physically go. Right now, the tension is agonizing, but the moment that energy shock releases, that rubber band is going to snap forward with incredible force.
Precisely. If the energy shock fades and inflation expectations drop, the entire investment strategy will shift on a dime. The goal right now isn't about figuring out what to aggressively buy today to make a quick, risky profit. The real goal is designing a portfolio that is resilient enough to survive this current stagflation storm.
Yeah, you want to protect your principal so that you actually have capital left over to deploy when the market recovers and those high-quality battered assets finally go on sale.
Exactly. It's entirely about patience, positioning, and understanding the deeper mechanics of the market.
And that really brings us to the big picture takeaway from everything we've explored today.
The overarching lesson here is that this conflict is not just a fleeting news headline that will be forgotten by next quarter. This is a profound macroeconomic shock that is entirely resetting the baseline for global asset allocation as we move deeper into 2026. The real risk to your retirement portfolio right now isn't misjudging the subtle nuances of Middle East politics.
No.
The real risk is looking closely at your portfolio and realizing you are vastly overexposed to interest rate hikes and highly vulnerable to a surging U.S. dollar.
It's all about checking your blind spots before you try to change lanes. And that leaves us with a real fascinating question for you to chew on as you review your own accounts this week. If this energy shock eventually does fade, if the Strait of Hormuz normalizes, oil flows freely, and the global market breathes a massive sigh of relief. Which of these currently battered, rate-sensitive assets will slingshot back the fastest? Which one are you keeping an eye on? Don't forget to subscribe and hit that like button.